most people are aware of in this call, I mean, we always get asked all the time, and at ArcView is, what is the market value of such licenses and operations within their respective states? So Jan, can you just give us an overview of what that looks like for the client and some of the pros and cons that go along with a market approach?
Sure. I think market approach is probably more complex, even though it looks deceptively simple. Because unlike the income approach, which is intrinsic in nature, it's based on the fundamentals of a particular company. Market approach is relative in nature because it's relative to the other similar transactions of a similar companies in the industry. Now, the objective here would be to estimate value based on how similar these comparable companies are priced by the market. And really, there are three sources of information relied on for the market approach. First, it's the public company records, transactions that are reported in the open market. Then there are private company transactions. These are primarily reported by the brokers. And then there are also prior transactions in the subject company itself. There are a number of databases that provide all the pricing details. Broad approaches of the market approach is to identify a comparable company, compare that value of those comparables or the multiples to the company being analyzed, and then convert these market comps into a standardized value. In my opinion, the use of the market approach has significant advantages and also significant disadvantages. So I'll briefly go through them. The advantages of the market approach, Jason, as you had said, that it's intuitive and it's widely known, and it's logical to assume that a company's value will more or less approximate or will trend the values of the companies, of similar companies, with the similar products, similar geographies, similar business performance. The approach itself relies on the actual transactional data, so it's not based, unlike the income approach, it's not based on the estimates or the workouts of a discount rate, which can include some certain assumptions that are might be subjective in nature. And lastly, the market approach relies or requires less information than, let's say, discounted cash flow, for example, just because the multiples are available. Now, the significant disadvantages of the market approach is that the method relies on the actually completed transactions, but the data might be stale, right? So if you are looking to value a company today and you are relying on the data from 3 years ago, for example, well, we all know what was happening 3 years ago. So the values themselves are not aligned on the timeline and might not be reflective of the current market condition, but might in fact reflect the conditions that existed at the time, which means that if the market conditions were depressed, well, then the values are depressed, and then you're trying to derive the values for your current transactions from the depressed timeline. And conversely, if the historical transactions took place during the period of market exuberance, then the valuations itself would, might not be realistic or might reflect that market exuberance and might not necessarily be relevant to the current transaction. And lastly, and probably most importantly, it's very difficult to find a Goldilocks company, right? A company that exactly matches the subject company's footprint, that exactly matches the subject company performance, and therefore, inevitably then, you might be forced to start adjusting the multiples, which introduces its own set of complications. I will say that market approach is widely used. It's widely used by many practitioners, but it is not the approach that will give you the ideal comparable or the ideal measure of value.
And we do have